I was asked to compare and contrast angel investors versus VC investors. Here goes. Angel investors are wealthy individuals who make investments in early stage startups. They may or may not be professional investors. Venture capitalists are professional investors who take a bunch of money from individual investors, pool it into a fund, and then invest that fund into a portfolio of startup companies. Angel investors typically invest small chunks of capital. Angel deals can range from as little as $10,000 to over $1 million. Venture capitalists tend to invest much larger sums. In 2024, the average VC investment is about $14 million. Angel investors usually operate with complete autonomy. They can do whatever they want. They're free to choose how much they want to invest and where they want to invest, often focusing on companies, founders, or markets where they have a personal interest. VCs, on the other hand, have very specific criteria around scalability and the size of the market. They typically fund companies that have a total addressable market of not less than $1 billion. And they're only interested in massive scale opportunities when they're interested in deals that have the potential for a 10x return on investment. So if they invest $1 million, they hope to get back $10 million upon exit through an acquisition or IPO. Angel deals tend to be flexible by design. Angels often negotiate directly with the founder, and the investment often takes the form of a loan that can be converted into equity later as the business takes shape. VC deals involve a lot of vetting, negotiations, legal work, paperwork, accountants, and a big deal team. And depending on the track record of the founders, the VCs typically hold most of the cards. They structure the deals so that they get paid first and sometimes allow them to walk away with a larger stake than founders might think they have negotiated. And that's where it gets dangerous for founders who don't fully understand the terms of their deal. Finally, there's the issue of control. Angels usually don't take board seats or offer a lot of guidance, but they can if the founder asks for it. That's all up for negotiation. VCs, however, expect and exert a lot of control over their portfolio companies. This can include taking multiple board seats, providing input on business direction, and sometimes encouraging founders to hire senior talent that they've vetted. They can also make a lot of demands that eat up a lot of founder time, ranging from unscheduled meetings and calls to all kinds of ad hoc requests and reporting. So what does this all look like in real life? Because I've done both. For my last startup, I negotiated a $125,000 angel deal with a wealthy friend, and the whole thing took about 10 minutes because we already had a relationship and he was already familiar with my business. Later, I brought on 2 more angels at $25K each, and I gave all my investors convertible notes. We had to pay interest on these notes, but our angels allowed us to wait to pay it until we had the cash flow to support it. So that's where that flexibility piece comes in. Our angels converted their notes after 10 years, which was right before we sold the company, and the deal closed shortly thereafter, and we all got paid. And by the way, remember when I said that VCs shoot for a 10x return on investment? Our angels got an over 11 times return on investment, so sometimes angels do pretty well. Contrast this with my experience raising venture capital. I raised $3 million in venture capital for my first startup, and it did not end well. In fact, it killed the company. If you want to know more about that, you're going to have to read my book or watch my TikTok video about how my VC broke up with me. Follow me for more content about startups and entrepreneurship.